Starting with our chapter number 1. Name of the chapter is Financial Policy and Corporate Strategy. Let us see that what are the learning outcomes of this chapter. This basically chapter is giving an explanation to us that how we can combine the different chapters of the financial management that we learn for the purpose of wealth maximization. Something like how you should design your capital structure so that your weighted average cost of capital is less. How you should be having the payment of the equity dividend so that the value of the shares increases. How you should take the decision with respect to the capital investment so that the NPV of the project is positive and we will be able to increase wealth of the equity shareholders. These are the things that we have so that we are required to combine, and based on that we are going to have the understanding of this chapter. This chapter is having no practical models, but it is only the summary of the things that we have studied so far. In case of the dividend discount model approach, the way we make the computation of the P0 as D1 divided by K minus C. Similarly over here, they have explained us regarding the growth rate. Growth rate is found as B into R, that is retention ratio into rate of earning. All these things have only been discussed over here. So, learning outcome of the chapter is strategic financial decision making framework. Next is strategy at the different hierarchy levels, financial planning, interface of the financial policy and the strategic management, balancing goal vis-a-vis sustainable growth rate. Balancing financial goals and at the same time we have a growth also means over here, so they have a point to explain us that whenever you take any decision, then in that case you don't have to see the return, you also have to see that what kind of risk which you have when you are going to undertake any of the investment proposal. Strategic financial decision making framework. Capital investment means capital budgeting that we were studying at our second level, maybe IPCC, maybe intermediate. So capital budgeting is the springboard like this for wealth creation. Means you take proper investment opportunities which have positive NPV and ultimately it will increase wealth of the shareholders. In the world of the economic uncertainty, the investors want to maximize their wealth by selecting optimum investment and financial opportunities that will give them maximum expected returns at the minimum risk. So it will give the maximum return to the investor with the lowest risk. Since management is ultimately responsible to the investors, the objective of the corporate financial management should implement investment and the financing decision which should satisfy the shareholders by placing them all in equal optimum financial position. Means ultimately as a finance manager, what happens that you have raised the funds from the investors and you are going to effectively employ the same in the business. So business should be able to give enough of the return so that you will be able to give capital appreciation to the investors and at the same time the recurring income in form of dividend to the investors. As far as the preference shareholders and debenture holders are concerned, to them we are going to give the fixed rate, so the payment to them to be made on the regular basis is of course a kind of responsibility that we have. And all these things are possible only if at all you are making proper investment. If at all you are making wrong investment, then in that case you will not be able to justify the return which the investors are expecting from you. That is what it wants to guide us. The satisfaction of the interest of the shareholders should be perceived as a means to end, namely maximization of the wealth of the shareholders. Since the capital is a limiting factor, The problem that the management will face is the strategic allocation of the limited funds. Whatever the funds that say you are going to get will be a kind of limiting factor. So these funds are required to be properly employed in the business. Between the alternatives used in such a manner that the companies will have the ability to sustain or increase the investors' return through continual search for the investment opportunities that generate funds for their business and are more favorable to the investors. Means exactly the same thing that we study in capital budgeting, the replacement of the machinery or mutually exclusive investment opportunity or expansion of the business. In all that, you take properly into account the opportunity cost that we have. We understand properly the sunk cost. We understand the irrelevant cost. All those things are required to be considered properly in decision making. Therefore, all businesses need to have the following three fundamental essential elements: clear and the realistic strategy, the financial resources, control system to see it through, and the right management team and the process to make it happen. So, again, we understand that say all these things will be very important. Like as far as the key points are there, head points are there, detailed discussion have been made. Strategy plus finance plus management, that is fundamentals of the business. Strategy may be defined as long-term direction and the scope of an organization to achieve competitive advantage through the configuration of the resources within the changing environment for the fulfillment of the shareholders' aspiration and expectation. If possible, we are required to make sure that say we use the same word for the purpose of selecting answer. We understand that so here strategy is basically long term in nature, competitive advantage through configuration of the resources within the changing environment. So that is like really very challenging for the companies also to make proper investment so that it is able to get the good return. We know that there is a constant updation in the technology. We know that there may be a change in the central government, state government, when that the policies are changing. If at all you are dealing in the foreign currency, then the exchange rate keep on fluctuating. We know that the customer's demand may change at any point of time. Whatever the raw material or other resources on which you rely, for that the prices may increase suddenly. All these challenges are there. Investors maximize their wealth by selecting optimum investment and financing opportunities, using the financial models that maximize the expected return in absolute term at minimum risk. So the return should be more and the risk should be less. What concerns the investors not simply the maximum profit, but also the likelihood of it arising a risk return trade-off from a portfolio of the investment. Portfolio of the investment means the different investments in which you have made investment, with which they feel comfortable and which may be unique for each individual. Dear students, in our chapter of the portfolio management, you might have completed that chapter or still you are going to understand that like in the coming time. We are having certain measures like Sharpe ratio. Sharpe ratio is calculated as X bar minus RF divided by standard deviation. Basically, the standard deviation is indicating the risk. X bar is indicating the actual return, and RF is indicating the risk-free rate of return. So, Sharpe ratio is indicating that what return you have generated for every 1% of the risk which you have that is, say you have undertaken in your investment. What is the excess return for every 1 unit of additional risk? That is what the Sharpe ratio indicates. We have Trainer's ratio. In that similarly, X bar minus RF divided by beta. So what these like the ratios are measuring, friends. These ratios are measuring that what is the risk adjusted return. Means if at all you have generated a very good return, but for that so you have taken a, that is a very high risk, then in that case that may not be considered to be very good. You should always make sure that say you are able to generate the return, say by minimizing the risk so far possible. That is what say this, like the paragraph says. Strategic financial management combines backward looking, report focused discipline of the financial accounting with more dynamic, forward looking subject of the financial management. It is basically about the identification of the possible strategies capable of maximizing an organization's market value. So we have to constantly look for the strategies which will maximize the wealth of the organization. And we understand that say like recently the kind of COVID-19 situation that say we have experienced, we know that say number of businesses have changed the way that say they were doing business. Unfortunately, number of businesses say like had a very like the long slack period. In number of businesses say there is a boom, and at the same time say importantly number of businesses have changed the way that they were doing business. That is what we understand is the changing circumstances. It involves the allocation of the scarce capital resources among competing opportunities. It also encompasses implementation and monitoring of the chosen strategy so as to that is achieve agreed objective. This is what we have. Next, strategic financial management is the portfolio constitute of the corporate strategic plan that embraces the optimum investment and financing decision. So that is combining the financing decision and optimum investment. Friends, in financing decision we have certain simple rules and regulations like this. We are having like the long-term investments, short-term investments, and medium-term investments. We understand fixed asset, permanent working capital, all these are the examples of the long-term investments. And it should be financed preferably with equity financing, with the retained earning financing, with preferential capital, with debentures, and so on. With these sources of finance, we should be making investment over here. As far as the short-term investments are concerned, that for that say you may rely on the bank overdraft, or you may go for say the creditors. Like that, say you can go for the short term, and for medium term you may go for public deposit or something like that. This is what we understand is a kind of moderate financing policy. Apart from moderate, we are having say the aggressive financing policy and also the conservative financing policy. In case of the aggressive financing policy, certain portion of the long-term investment is financed with the short-term funds in order to reduce the cost. In case of conservative, some of the short-term investment is financed with the long-term funds. That is conservative, wherein the cost will be more, return will be less, and risk will also be less. Over here, return will be more, but the risk will also be more. Again, at our IPCC or intermediate level, we have discussed so these kind of the financial policy. That is what it says. And of course, in addition to that, we should be having the proper debt financing proportion in the capital structure. Like one of the very good capital structure theory which I feel is about the traditional theory, which says that initially when you introduce the debt financing, then weighted average cost of capital is falling down. Then you further raise debt financing, weighted average cost of capital becomes constant. After that, so you should not raise debt financing. In that case, your weighted average cost of capital increases because the cost of equity increases at a higher rate. Initially, cost of equity increases at a lower rate, and even initially, the debt financing will be expecting lower rate. However, later on, the debt financiers will also expect the higher rate of return. These are the things that we have studied for the financing decision in our capital structure theory chapters. All those things are required to be considered over here. Are required to attain the overall specified objectives. In this connection, it is necessary to distinguish between the strategic, tactical, and operational financial planning. Strategic financial management, in that the strategic level, in that say the long term process, and it is managed by the senior management. Tactical level, it is the intermediate plan and it is managed by the middle level. And the operational, that is what's the short term process, and it is of course managed by the lower level of the management. Irrespective of the time horizon, the investment and the financial decision functions involve the following functions: continuous search of a best investment opportunity. So this is what our chapter of capital budgeting. Selection of the best profitable opportunities, same. Determination of the optimal mix of the funds for the opportunities. This is what we have discussed in capital structure theories. Establishment of the system of the internal control. This is the operational aspect, just to make sure that there is no fraud and we will be able to implement the things as what we have decided. Fifth, analyze the results of the future decision making. This is again the management decision. So again, these head points are important from examination point of view, and in that you are required to write the relevant portion. Since the capital is a limiting factor, strategic problem for the financial management is how limited funds are allocated between the alternative uses. So number of investment proposals where you should make investment is a decision. The dilemma of the corporate management is resolved by pioneering work of Jensen and McLean 1976, which is popularly known as agency theory, which you have already studied at your intermediate, that is IPCC level. Friends, the agency theory, I hope you recall, is something like this. Let us assume that Mr. X is owner of a business. So he is investing the funds, he is managing the funds, and he is getting return. So of course he is going to do the best work. There is no doubt about it. In case of a corporation, what happens that promoters are there, minority investors are there, they make investment. Whatever the return which is generated is proportionately distributed, that is between them. However, any of the decision which is taken in the company may be favorable for the promoters and not for the minority. And because of that, there is a concept called agency theory comes, which we have studied at our IPCC level. According to this theory, strategic financial management is a function of four major components based on the mathematical concept of expected NPV, maximization, financing decision, investment decision, and dividend decision. The key decision falling within the scope of financial strategy includes investment decision, that is the capital budgeting, financing decision, that is the capital structure theory, dividend decision, and portfolio decision. Portfolio decision and investment decisions are very much connected. that you should be making investment in the different businesses in such a way that so the overall you will be able to have a situation wherein if at all one of the business is falling down because of the market situation, then in that case the other business is able to give you some return. And the reverse, if at all this business is falling down, then the other business is able to give you the return. So you are having say the more than one source of the income, so that say the loss in one will compensate with the gain from the other. For dividend decision, we are having certain dividend policy theories called Walter model, Gordon model, Modi Gilani Miller approach, Linton model, Graham and Dodd model, in which we decide that say how to take decision with respect to the equity dividend payment. For financing decision, again we have the net income approach, net operating income approach, again Modi Gilani Miller approach, traditional approach, trade-off approach, like that. For investment decision, we know that a number of techniques are there, NPV, IRR, all those things are required to be combined. The key decisions falling within the scope of the financial strategy include the following. Financing decision. These decisions deal with the mode of the financing or mix of the equity and debt capital. So this is the capital structure here. You may write a few things like this over here, so that will help you to remember the things later on. Dividend. These decisions determine the division of the earning between the payment to the shareholders and reinvestment. And friends, this dividend decision is basically the equity dividend rule. Because as far as the preference dividend is concerned, for that the rate is fixed. For the debenture holders, so there is payment of interest only. So whenever you read a word dividend decision, you always have to understand it is talking about the equity dividend decision. Investment. These decisions involve the profitable utilization of the firm funds, especially in the long-term projects. That is capital budgeting or investment decision. Since the future benefits associated with such projects are not known with the certainty, investment decision necessitates the involvement of the risk, expected return and risk. Friends, if at all you recall, then at your intermediate level you were studying a chapter called risk analysis in capital budgeting. So it is talking about the same. Wherein we have the expected NPV, we have standard deviation, we have variance, then we have certainty equivalent factor, coefficient of variation, sensitivity analysis, scenario analysis, decision tree, simulation analysis, all those things. And definitely friends, in this point, you may mention all these things, say, and that is absolutely acceptable. They have provided over here, say, a reference of the risk, and these are the measurement of the risk, which you can always mention in examination because these are the relevant content with respect to that point. Even over here, for the dividend decision, if at all you are mentioning Walter model, Gordon model, Modi Gilani Miller approach, residual dividend policy theory, then Linton model, Graham and Dodd model, these are also acceptable friends. In financing also, same thing is applicable. Portfolio decision, in that you have to keep in mind the concept that say you have studied or you are going to study called correlation coefficient between the businesses. It should be less so far possible. With that, so you will be able to reduce the risk. You are going to understand the diagram over there, something like this. If at all the correlation coefficient is less, then in that case, so the risk of the combination will fall down automatically. On x-axis we take the risk and on y-axis we take the return. If you have studied portfolio management, you will be able to understand this diagram wherein it says that say the risk gradually reduces without reduction of the return if at all the combination is having lower correlation coefficient so far possible. These decisions involve evaluation of the investment based on their contribution to the aggregate portfolio, that is aggregate performance of the entire corporation, rather than the isolated characteristics of the investment themselves. And we have the best examples in India, like Tata Group of the companies, which have the business in more than one sector. Reliance Group of the companies, again the same thing. Adani Group of the companies, they are having say their exposure in more than one sector. That is what say we have completed the first segment. So again the first slide is repeated, and we are going to now have the discussion of the strategy at the different hierarchy levels. That is what's the second point. Strategy at different hierarchy levels, wherein we understand it's the corporate strategy, business you should be in. It is a strategy, is a set of the analysis techniques for understanding and influencing your company's position in the marketplace. Enterprise strategy is concerned with the match between your company's internal capabilities and external environment. We already have discussed something like this, that the Kodak company had not introduced the digital camera. So that was a strategic decision. We already had discussed that the Nokia had not supported the Android software in their phone. So that was the strategic decision. So this is what they are talking about, the strategic decision. We understand that whatever the mergers and acquisitions that take place, that is also like the strategic decision, wherein the Reliance company is selling their 20% of the holding to one of the company which is in UAE. Then in that case it is a big strategic decision. Facebook is acquiring WhatsApp or Instagram. That is what we understand is the strategic decision to be the market leader. Business strategy, techniques to beat the competition. Functional strategy, that is on the lower level. Operational methods to implement the techniques. Corporate level strategies. Corporate level strategy fundamentally is concerned with selection of the business in which a company should compete, also with the development and coordination with the portfolio of the businesses. Portfolio of the businesses means you are already doing one business and you are considering to enter into other line of the business. That is a portfolio of business. Corporate level strategy should be able to answer the three questions. One, suitability, feasibility and acceptability. Whether the strategy would work for accomplishment of the common objective of the company. That is what you have to see. Determine the kind and the number of the resources required to formulate and implement the strategy. So do you have adequate funds for the purpose of doing business or not? So that you are required to see. Do you have the adequate resources in terms of the manpower, in terms of the infrastructure? All these things do you have? It is concerned with the stakeholders' satisfaction and can be financial and non-financial also. We understand that if at all an investor is making investment in the Tata Group of the companies and Tata company is entering into the business of alcohol, then in that case the investors will not be happy with that decision, because we have a sentimental value when it comes to the investment that I have made with the Tata company. I cannot accept that the Tata company is entering into such kind of business which is morally not ethical. Even though it is permissible, it is legal in India, but if at all Tata Group of companies doing that kind of business is not acceptable to me as an investor. If it is dealing in certain products in which it involves non-veg, again in that case I may feel as an investor that it is not acceptable to me. If at all the Tata company starts importing the goods from China, then in that case again it is not acceptable to me. So certain these kind of non-financial factors are also connected to the decision that you take, because the investors are having certain expectation from you. business unit level strategy, SBU, strategic business unit, may be any profit center that can be planned independently from other business units of the corporation. At the business unit level, the strategic issues are about practical coordination of operating units and developing a sustaining competitive advantage for the products and services that are produced. Characteristics: it has a distinct mission and specific target market, control over the resources, has its own competitors, has plans independent of other strategic business units. Strategies at SBU level defines how each business unit decides to operate within its given industry. That is, group of the firms competing from the same served market with closely related or similar products. SBU level strategies are mostly customized for each firm and its industry. However, they may be broadly categorized into three types: overall cost leadership, differential strategy, focused cost leadership differentiation. Next is functional level strategy. The functional level is the level of the operating division. Okay, that's very simple. And the departments. How effectively you are able to execute the things that say you can think about. Strategic issues at this level are connected and related to the functional business process and value chain. Value chain means that say you purchase the raw material, you process the raw material, you convert that into finished goods. So you send it to the wholesaler, from wholesaler to retailer, retailer to directly customer. So this is what we understand is a value chain. Involves the development and the coordination of the resources through which the business unit level strategies can be executed effectively and efficiently. Function unit of the organization are involved in higher level of the strategies by providing input to the business unit level and corporate level strategy, such as providing information on the customer feedback or on the resources and the capabilities on which the high level strategies can be based. Once the high level strategy is developed, the functional unit translate them into discretional, that is say discrete action plan that each department of the division must accomplish for the strategy to succeed. So once at the top level the strategy is say decided upon, then at the functional level say it is getting executed so that say we will be able to execute the goals that we have. Functional management, functional level strategy for in that the major activities are human resource management, that is appointment of the proper person for say the required post, research and development, that is say the innovation, third marketing, when we have to be competitive in the market, finance is also included, and production. Again, we always understand that say these head points are very important. Corporate strategy deals with the deployment of the resources. You already have acquired the resources, now you have to utilize the same. And financial strategy is mainly concerned with the mobilization and the effective utilization of the funds. So corporate strategy and financial strategy, for that so the difference is mentioned over here. It is deployment of the resources, and over here mobilization and effective utilization of money. The most critical resource that a business firm likes to have under its command. Truly speaking, other resources can be easily mobilized if the firm has adequate monetary base. To go into the details of this interface between the financial strategy and corporate strategy, financial planning and corporate planning, let us examine the basic issue addressed under the financial planning. So these things are there. So now we are entering into the third, that is a financial planning. Financial planning is the backbone of the business planning and corporate planning. It helps in defining the feasible area of the operation for all types of the activities and thereby defines the overall planning framework. Financial planning is a systematic approach whereby the financial planner helps the customer to maximize his existing financial resources by utilizing the financial tools to achieve his financial goals. I can give you certain simple examples like this. Let's say we study something like called Baumol's model of the cash management. So in that, what we try to do, we try to minimize say the holding cost of the cash and so the transfer of the cash say from the liquid securities to the current account. This is what say we understand is the effective utilization of the funds that we have, or whatever the function that say we have to discharge, that we discharge properly. We are having a certain system like lockbox system. We have something like called concentration banking. We know that say for foreign exchange dealing, we are having the hedging of the that is the foreign exchange risk using the forward contract, option contract. These are the things that say what we are doing in the financial planning. We have to effectively execute all these things say which we are required to discharge in an organization. That is what it says. There are three major components of the financial planning: financial resources, financial tools, and financial goals. For an individual, financial planning is a process of meeting one's life goal through the proper management of the financing. So they have included even for an individual also. We understand that so the retirement planning is what so the planning that an individual will have for whatever your child or for your son, daughter. So the education planning that you have for their that is so the marriage you are having say certain planning. That is what we understand is a financial planning. These goals may include purchasing of a house, savings for the children's education, or planning for your own retirement. It is a process that consisting of the specific steps that help in taking the big picture look at where financially you are. So friends, many a times you might have heard something like this, that say for senior citizen it becomes very difficult to survive. Why? Because the rate of interest in the market is falling down and inflation rate, what they report is different thing, but inflation rate is actually going up. So whatever the savings that say any senior citizen is having, says number of times not meeting with their say just routine expenses. Why? Because the income is reducing, because the rate of interest is going down and expenses are increasing, so because of the increase in the inflation rate. So this gap is falling down, because like of course at any point of time, say for any senior citizen, always say they have an intention, always they have a perspective that say we are able to meet with our routine expenses say out of the recurring income. But of course it is not possible every time, and rather say over here also it is not becoming possible because of this reason. So you don't have a choice but to go for the equity investment. Always remember that say over a long period of time, always remember that say over a long period of time, the equity investment will only be able to beat the inflation. Uh, like there are a number of researches which have clearly proven that even for the last like 100 years research, yes that is talking about last 100 years research, as far as the treasury bill is concerned, it will have say the if at all you start investing over here, after 100 years you reach over here, and the same equity will have this amount of the return. So there is always a huge gap that they will be having. So this is the equity and this is the debt investment. So over long period of time, anybody does not have a choice but to go for the equity instrument only, because the debt instrument cannot beat the inflation over a long period of time. So this is what say the part of the financial planning. Outcomes of the financial planning are the financial objective, financial decision making, and financial measure for the evaluation of the corporate performance. Financial objectives are to be decided at the very outset so that the rest of the decisions can be taken accordingly. The objectives need to be consistent with the corporate mission and corporate objective. So now they have translated the same to the company. Financial decision making helps in analyzing the financial problems that are being faced by the corporate and accordingly deciding the course of the action to be taken by it. The financial measures like ratio analysis of the cash flow statement are used to evaluate performance of the company. So we understand that say, there are certain barometers that say you have. So you have to see that say whether you are able to say surpass them or not. Whatever the benchmark that you have, are you able to surpass that or not? That is what say we are going to have a discussion over here. Means say a kind of comparison you have to make. Your gross profit ratio, your net profit ratio, then we understand that say your market share, all those things that say you always have to see. If at all your sales increases by 10 percentage, however the your market share reduces by 20 percentage, then in that case it is not a good sign. Your sales increases from 1 lakh to 1 lakh, that is say 10,000. So there is an increase. However, earlier the market was of 5 lakhs and the market has say just I am taking a figure has increased to 8 lakhs. So earlier you were having say the 20% market share. Now you are having let us say the 15% market share. This is not a good sign. That is what say we understand. These things are included over here in the financial measurement. So the financial planning process, in that gathering client information, establish goals and objective, this is what say a kind of portfolio management that say we do. Yes, gathering client information, establish goal and objective, analyzing the financial situation, developing and presenting the plan, implementation and monitoring and the reviewing of the plan. So this is say to some extent connected to the portfolio management. Suppose like a person at the age of 30 comes to you, then in that case we can say that say he is having say some long time period for making investment. He is having say let us say the time period of another 20 years in which he can make investments only and he does not have to withdraw. If at all a person is coming at the age of 45, then in that case he does not have so long period for the investment. Why? Because in some time period only, so there will be an expense for the marriage of his say children, for education of his children. So in this case the comparatively he is having less time. So accordingly you should make investment. Then we understand that say if at all a person is working, let us say into IT sector for example, then whatever the investments which are made of that person should not be made in the IT sector. It should be made in other than IT sector. Why? Because if at all the IT sector is going down, you already have made investment in the IT sector only, then what will happen? It may happen that so you lose your job because that sector is going down and even your portfolio is falling down. So you should not be having a connection like this. You should be making investment into say the separate sectors. That is what gathering of the client information, establish goals and objectives. We need to have a proper conversation with the client to understand the risk bearing capacity that the client has. If at all the risk bearing capacity is less, even at this stage, then in that case, say we should not suggest more of the equity funds. In also equity, we are having say the small cap, mid cap, and large cap. Small cap is the most risky, mid cap is having comparatively less risk, and large cap is comparatively least risky. So, whatever the equity investment of Mr. X is invested should be more in the large cap if at all his risk bearing capacity is less. That is what it says. Analyzing the financial situation, whether he has his own house or not, something like that. Developing and presenting the plan. What I said to you, the equity and debt proportion like this. In equity also, so the different investments. In debt also, we understand that so the treasury bill is considered to be the most safe. Then when you make investment in corporate debt, then in that case the return will increase, but the return will not increase without increasing the risk. We have experienced number of times that the corporates are not able to give the return because why we understand that say their default. That is the reason the risk is there for the investor. Implementation of the plan, monitoring and the reviewing the plan. If at all the investment is made for these 20 years, then in that case constantly we should review it. Next, interface, the first slide again, of the financial policy and strategic management. The interface of the strategic management and the financial policy will be clearly understood if we appreciate the fact that the starting point of an organization is money and end point of the organization is also money. No organization can run an existing business, promote a new expansion without a suitably internally mobilized financial base, or both. That is internally and externally mobilized financial base. So practically friends, what happens at a number of times, say you will be able to expand or you will consider to expand your business only if you have the retained earning. If you don't have the retained earning, then in that case say you would not like to say expand. Sources of the financial and the capital structure are the most important dimension of a strategic plan. The need for the fund mobilization to support the expansion activity of the firm is very vital for any organization. The generation of the funds may arise out of the ownership capital, wherein it is retained earning and equity financing. Borrowed capital, in that debt financing, loan financing, preferential capital financing. Ownership, in that equity and preferential. Over here they have mentioned the preferential capital as a part of the ownership. However, in number of times say it is taken as the outsiders funds. Borrowing, in that the short term and long term. In long term we have the debentures and long term loan. In short term public deposit, cash credit, bills payable, trade credit and overdraft. And further of course the retained earning. Interface of the financial policy and the strategic management. The starting point of an organization is money and end point is also money. The fact must be appreciated so that interface of the strategic management and the financial policy will be clearly understood. Strategic planning, operational planning and financial planning. In financial planning, it comes to forecasting, financial concentration, analysis, cash flow, budgeting, reporting. All these will come in the financial planning, and strategic planning in that the reporting and analysis. Interface include the important points as first is the debt equity ratio. We know that the debt equity ratio is indicating the proportion of the debt in the capital structure. Debt equity ratio will have so the advantage to the company of lower cost of the funds. Why? Because when you are giving fixed to someone, then in that case you can bargain for the lower rate. Second, further, you have an advantage called trading on equity. Trading on equity means you are required to pay interest at the fixed rate, you are earning at a higher rate. So whatever the excess earning that you have, so that goes to the equity shareholders, and with that, so the return on equity increases. So these are the advantages that you have, and what are the disadvantages to the company? One, cost of equity increases. Why? Because importantly, risk for the equity shareholder increases. Gradually, you will have the higher rate of interest expectation even for the debt financiers. Why? Because risk even for the new debt financiers increases. Very importantly, so the chances that the company is going in the liquidation increases. Why? Because we understand that if at all you are not able to make the payment of the financial charges to the debt financer, then in that case the company will go into the liquidation. So these are the things that we have. There are certain norms for debt equity ratio which need to be followed for minimizing the risk of excessive loan. For instance, in case of the public sector organization, the norm is 1 is to 1. For private sector firm, the norm is 2 is to 1. It also depends upon the planning mode of the organization. For capital intensive industry, where the investment in the plant and machinery, investment in the land and building, investment in the fixed asset is more, the proportion of the debt in equity is much higher. Similarly, in case of the high cost project in the priority sector and for the projects under developed regions. In addition to that, mentioning all these which are relevant is absolutely acceptable, friends. Second, investment and fund allocation decision. In that, say importantly, you are required to make investment in like the businesses which have lower correlation coefficient. A planner has to frame the policies for regulating the investment in the fixed asset and restraining from the current assets. Investment proposals mooted by the different business units may be divided into three groups. One type of the proposal will be for addition of the new product by the firm. Another to increase the level of the operation of an existing product through either an increase in the capacity of the existing plant or setting up of the another plant for meeting the additional requirement. The last is for the cost reduction and efficient utilization of the resources through new approach and or closer monitoring of the different critical activities. Now, given these three types of the proposals, a planner should evaluate each one of them by making within the group comparison. In the light of the capital budgeting exercise, in fact, the project evaluation and project selection are the two important jobs under the fund allocation. So this is what they have mentioned, that there are three things. One is the expansion of the existing business, one is say the addition of the new product, and the third one that they have provided. Many a times what happens, friends, that we have even the kind of practical examples wherein the company is required to choose that say in which country you should expand your business. Suppose presently you are doing your business in India and you are considering expansion of your business, let us say in United States of America or United Kingdom. In that case, so what is the correlation coefficient that say both the businesses have with your existing business is also required to be considered for the overall decision making. That is what we understand. Dividend policy, in that as I told you, different models are there. One of the point on which they are emphasizing is what is the rate at which you are able to earn as a company and what is the rate at which the shareholders are able to earn. If at all you are able to earn at a higher rate, then in that case you should retain the funds in the business. If at all you are able to earn at a lower rate, you should distribute the earning to equity shareholders. If it is same, then in that case retention of the dividend payment will not have any impact. That is what's the conclusion that we have for certain dividend policy theories. In addition to that, practically number of other considerations which are required to be taken into account. For example, what your peer group of the companies are doing. The companies which are doing similar business like you, what kind of dividend policy that they have. If at all they are making constantly, regularly payment of the dividend, so always there is an indirect pressure on you to make sure that you also give the dividend to the investors. In spite of the fact your own rate of earning is exceeding the rate of earning of the shareholders. Second, what kind of legal framework is there? You want to pay substantial earning in form of dividend, yet legally it is not permitted to you, that is legally you are not permitted to do the same. What may be the reason? The reason for that may be like this, that you have raised the debt financing, so certain portion of the earning is required to be parked aside in form of, we understand that the sinking fund reserves. In that case, what is the legal situation is what you are required to see. Third, the tax status of your investor. Let us take a situation like this. Whatever the investors that you have, majority of the investors are falling in high tax bracket. Further, dividend income is taxable in the hands of investor. Further, capital gain is exempt. Suppose the situation is like this, then in that case you should pay less amount of the dividend. Why? Because it would be taxable in the hands of the investor. If at all you retain and with that the capital is appreciating, then in that case effectively the investor would be getting a higher return. That is what we understand. What kind of inflation is there in the market and such other things are there, so which we understand. Suppose a company is having a good amount of the profit. However, the liquidity position of the company is poor. And so there is a kind of pressure on the company to give some return to the investors. Because everybody is expecting the company to give return. At the same time, the company is having a good reinvestment opportunity. In that case, what the company can do, the company can issue the bonus shares. Issuing bonus shares is possible because say there is a profit. If at all you issue the bonus shares, then in that case your poor liquidity position is not going to be affected, and investors will also be able to get the liquidity if at all they want by selling their investment in the secondary market. These are certain things that you have to consider. Dividend policy is a decision deals with the extent of the earning to be distributed as dividend and extent of the earning to be retained for future expansion. So whatever is the earning available to equity shareholders, split of that. From the point of view of the long-term funding of the business growth, dividend can be considered as a part of the total earning which cannot be profitably utilized by the company. Stability of the dividend payment is a desirable consideration that have the positive impact on the share price. So it says like this, preferably you should not be having the dividend portion like this. Investors feel that there is a risk. You may make payment of the lower amount of the dividend, but your dividend payment should be like this. Where investors feel that this company is at least maintaining the previous year's dividend in the current year. If not, then in that case they maintain, or they give an increase. So every year they maintain the previous year, the dividend amount, and if possible, say they gave an increase in it. That is the way you should be having, say, the stability of the payment of dividend, and it will have the positive impact on the share price. And this is what it is provided by the Lintner model. You can always mention these things additionally. The alternative policy of paying constant percentage of the net earning may be preferable from the point of view of both flexibility of the firm and ability of the firm. If at all you pay a constant proportion of the earning to be paid in form of dividend, then in that case, a situation like this may arise with the fluctuation of the earning. Because what happens, let's say you always have a policy that say 50% of the earning to be paid in form of dividend. Then in that case, if at all your earning falls, so the dividend amount will also fall down. It also gives a message of the lesser risk for the investor. Yet, some other companies follow a different alternative. They pay a minimum dividend per share and additional dividend when the earnings are higher than the normal earning. In actual practice, investment opportunities and the financial needs of the firm and the shareholders' preference for the dividend against the capital gain resulting out of the share are to be taken into consideration for arriving at the right dividend policy. So it says that, say, number of times the investors have more psychological satisfaction when they receive the dividend in cash instead of, say, appreciation in the price. So this is what, say, they have mentioned over here. Shareholders' preference is, say, making a difference over here for dividend against the capital gain. Why? Because that gives a psychological satisfaction to me that I am receiving something in form of return. Alternatives like cash dividend, stock dividend. Stock dividend means bonus shares. Are also examined while working out idea of the dividend policy that supports and promotes the corporate strategy of the company. Thus, the financial policy of a company cannot be worked out in isolation. You cannot do it, say, like as a separate thing, and other finance, that is a functional policy. It has a wider appeal and a closer link with the overall organizational performance and direction of the growth. These policies being related to the external awareness about the firm, especially the awareness of the investor about the firm in respect of its finance, that is internal performance. There is always a process of evaluation active in the minds of the current and the future stakeholders of the company. As a result, preference and patronage for the company depends significantly on the financial policy framework. All of you might have heard something like this, that in Tata group of the companies, when there was, say, a kind of for the top position in the Tata Sons, war between the Tata group and, say, the Mistry group. In that, say, the kind of decision which was taken by Mr. Mistry was that, say, making less payment of the equity dividend for Tata Motors Limited. So that was, say, one of the point which, say, Mr. Ratan Tata had raised, that, say, the investors who make investment with Tata Group, they are expecting the regular dividend income, and say, like, the amount of the dividend which was paid was very less. That was, say, one of the point. Hence, attention of the corporate planners must be drawn while framing of the financial policies, not at a later stage, but during the stage of the corporate planning itself. This is very difficult task compared to the usual cause and effect study, because the corporate strategy is the cause and financial policy effect, and sometimes financial policy is the cause and corporate strategy is effect. Now the next is balancing financial goals vis-a-vis sustainable growth. Next is the balancing financial goals vis-a-vis sustainable growth. Balancing financial goals vis-a-vis sustainable growth. The concept forces the manager to consider financial consequences of sales increases and to sales growth goals that are consistent with the operating and financial policies of the firm. Questions concerning right distribution of the resources may take a difficult shape if we take into consideration rightness not from the current stakeholders point of view but from future stakeholders point of view also. Sustainable growth is important to enterprise long term development. Dear students, the word sustainable growth is very important. It means that say you are not having so the growth only for some years, you are able to give the growth over a long period of time. That is considered to be the sustainable growth. Too fast, too slow growth will go against the enterprise growth and development. So the financial should play important role in enterprise development, adopt suitable financial policy initiative to make sure enterprise growth speed close to the sustainable growth ratio and have sustainable healthy development. Friends, there was a time when if you book the Bajaj scooter, then you get the delivery of the Bajaj scooter after 18 years. Yes, there was a time that the Bajaj company was having so many orders that so the waiting time for getting the Bajaj scooter was 18 years. I purchased scooter today. Okay, it was booked before 18 years. I can immediately sell in the market that scooter at double price. That was the situation which the Bajaj company had. So at that point of time, say for Bajaj company, it was important that not only to look at the present business that say they have, but also to make sure that say this kind of the business that able to sustain even in future. We know that so the Bajaj has entered into number of other businesses, including the finance, electronic appliances, and such other. Of course, the automobile is always there. So that is what we understand is like the sustainable growth is important. Balancing the financial goals vis-a-vis the sustainable growth. For that, an example is given to us. The example is given by them for an oil company in which they have specified that so the overall whatever the like we can say that so the resources of the oil that we have is of course limited. Okay, we take oil, then of course there will be a point at which say that entire oil will be exhausted. That is what say will have one day a situation. That is the reason say the oil company itself is say making an advertisement that say we should be having say the less consumption of the oil. It means that say the company itself is having say certain programs in which say they encourage like their customers say to use less oil. Why? Because they are not looking for the short term business, they are looking for the long term business. That is what's an example that they have given. To take an industry